There are four key asset classes, namely cash, fixed interest securities, also known as bonds, equities, also known as shares, or property. Each and every one of these have different characteristics and it's not like for like. Equities or shares are a way of owning part of the company and in return taking advantage of capital growth as the share price increases over time and income in form of dividends, which is distribution of company profits. Bonds or fixed interest securities, these are loans raised by the government or companies to generate cash. So governments issue gilts and companies corporate bonds. In return, the government or the company will pay a fixed amount at a regular interval over a period of time and return your capital at maturity. Bonds or fixed interest securities can offer stable returns and are perceived to be lower risk than equities. The value of bond investments are sensitive to changes in interest rates, carrying an inverse relationship. Cash includes deposits at banks, building societies. It's great for flexibility and access and useful to place funds in this area that may be required for emergencies or any planned or expected expenditure. Any excess funds has a risk of losing its real value through inflation. Properties is another form of asset class whereby you're generally investing in commercial properties such as shopping centres, office outlets, in return for a regular income as rental income and capital growth as the value of the properties enhance. It's generally a good protector against inflation, and property is a good diversifier and normally acts in between equities and bonds. A pooled investment is a way of having exposure to all these asset classes relative to your risk tolerance. Pooling together different asset classes gives greater degree of diversification than investing in a single asset class. Diversifying across a broad range of investment strategies, styles, sectors, regions can help reduce the market volatility that comes with a single asset class. Now take a moment and work out what types of return will be generated from these different asset classes. Did you guess correctly? Timeline has done a study using data going back to 1925 to 2019, and it's worked out what the returns have been generated by each asset class. And we need to pause for a moment and roughly guess what returns are likely to be generated by each individual asset classes. Now, if the funds were placed in a balanced portfolio, what sort of returns would you expect during the same period? What are your thoughts on these figures? Would you think it's useful to diversify your money in different areas or leave it all on cash? Just to personalise this, in order to maintain your standard of living, you pay towards gas, electric, food, shopping, water rates, TV licence, clothing, home contents insurance, car insurance, fuel, travel to work, and that's not including furniture, carpets, curtains, cooker, bedding, towels, white goods such as fridge, freezer, washing machine, kitchen utensils, TV. Now, if I asked you to forego one item for the other, such as forego your towels for your day-to-day clothing, or forego crockery for your TV, or forego fridge for the benefit of a freezer, how would that affect your standard of living? Likewise, your investments need a spread across different asset classes to blossom during different economical environments. Just like we know there are 4 seasons in a year: spring, summer, autumn, winter. However, we can't predict exactly when one season will start and the other will finish. Likewise, with regards to asset classes, because no one can time the market movements exactly, so we never know when we'll be entering a bull market or a bear market at precise moments, it's wise to have a diversification across different areas to continue to benefit from better return potentials.